Hi, so I wanted to do a little teach-in on the structure of markets and just a bit of a history lesson. And I'm going to use just for the purposes of this video just the very recent history. For those of you who have been working in markets for a long time, the thing about what I'm about to tell you is that this is applicable and interesting to people in my professional world. We talk about it all the time, and also down to the most newbie retail investor in the world. This is something that everyone needs to take note of, and everyone needs to understand, because this is the critical in terms of understanding the positioning and the characteristics of a particular market that you're in. Now, and we'll do different history lessons, as I've mentioned. We did one on how markets have changed. We did one on trading and gold, and now we're going to do one on the positioning in the market and how important that is. Now, if you rewind the clock literally just to April, right? And those of you who and there's only a few of you, by the way, but I've got to just mention in case they are watching this video, who tell me that markets can only go up. Just have a look at April, right? We're currently we just started October. April is really not that long ago. And we had one of the most violent sell-offs that we've had in the last 15 years. We've only had sell-offs to that magnitude of that standard deviation three times. Okay. So just to put in perspective how rare they are, and what I mean by that is a 25% sell-off or drawdown from the highs within the space of 2 weeks. Look, you can see it there on the chart. It's the most recent sell-off on that chart. Now, what happened? Trump came out. We were all expecting the narrative and the noise surrounding the tariffs started to build. Everyone had started to get a bit concerned about pricing in 10%, 20%, maybe 30%. For China, for example, and the market had started to sell off a bit. And this is just so amusing. It's not amusing for want of a better word, as to how subjective and silly the market can be, right? So we were all getting very nervous about 30% tariffs on China and 20% on the world. The numbers were chopping and changing, right? Then he stood on the White House lawn and he gave us that list of reciprocal tariffs, right? And the numbers were in the hundreds for most of the Southeast Asian nations and most of the nations that he claims, well, not claims, most of the nations that they have a current account deficit with, and he essentially made up tariff numbers that they're charging him, and therefore that he's going to charge them in response, reciprocal tariffs. It was all based on trade balances. Anyone that has a positive trade balance with America was targeted. Take Vietnam, for example. They have a very big trade surplus with America for obvious reasons, because the likes of Nike do their manufacturing there. So the list goes on, but the point is this: everyone got very, very, very worried and very bearish very quickly. Now, in the professional world, partly that is the characteristics of these people, right? These people are managing billions of dollars. If they have a 5 to 10% sell-off in their book, they get fired. If you guys have a 5 to 10% sell-off in your book, nothing happens and no one cares, right? You just, whatever, it's nothing. But these guys are managing billions of dollars, and they have to manage their risk. If the market is down 5% in a straight line, and we're doing circuit breakers, and it doesn't matter really what they think. They have to, as a matter of professional practice, they have to cut their risk, which adds to the selling. Then, of course, the machines who chase momentum and chase price action up and down, they do their selling. And then, of course, you've got the retail universe who just sit there, many of whom have never seen a sustained market sell-off before, who just buy every dip, right? So they did very, 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 very well out of this. But let me get to that in a minute. I spent most of that beginning 5 to 6 days after that announcement, when the market was just tanking every single day, talking to my clients, saying, this is obviously going to get walked back. I mean, this is what Trump does. This was a very extreme example of what he does, but nonetheless, of course, he's not going to ruin his own economy. Of course, he's not going to ruin his own stock market. And of course, this is a very, very aggressive, but nonetheless, Trump negotiating tactic. And lo and behold, he puts on a 90-day reprieve on China and starts getting walked back bit by bit by bit. And the market moved up 12%. The Nasdaq was up 12% in one day. No professional investor took part in that rally. Zero, right? I'm sure retail were buying the dip and they probably made some good money out of it. The machines probably made some good money. The algorithms made some good money out of it, the CTAs. But the professional investors, the big money, did not participate in that. The market then came off a bit more, and the professionals expect it to roll over again. There's no participation by the professionals at this stage. Market then it rallies again, and then it comes off again. It rallies again, and that's the way it works after a big sell-off. It's very, very volatile and choppy, but it made its way higher and higher and higher, and we got back to the all-time highs, as you can see on the chart there. And still, the professionals have not participated. In fact, they're putting more money into the money market accounts because they're expecting markets to roll over and something bearish to happen. And things to not continue in such a bullish fashion, and that feeds upon itself over, and then the shorts get stopped out, and then some of them have to participate. Meanwhile, retail's piling into it. Meanwhile, the AI fundamental bottom-up trade is just on fire, which is also needs to be considered during this whole thing, because we have a big macro event, but at the same time we have a very, very strong micro tailwind in the form of AI spending, capex spending, and that is holding up the indexes, because most of the big companies who run the indexes are involved in this trade. So that's also part of the equation. But I'm talking about the positioning. So we get, after one of the most aggressive sell-offs in the last 15 years, everyone's bearish. All the professionals are penciling in S&P 500 10% lower than than where it was on the lows. The retail people have all piled in and bought it. The machines have piled in and bought it. But here we are, miles above the all-time highs yet again, and we're in the same situation. The professional world are still max long cash. They're putting more money into money market accounts. They're not participating in this market, and they expect the market to sell off at some stage. And retail people are just still roofing every single one of the speculative stocks. It's a very, very strange situation, to say the least, and it's all because of the aggressive reversal in sentiment and positioning that was caused by the Trump tariffs. Now, I wanted to make this video to make clear the power of positioning, okay? If all the professionals were very, very long this market, it would be so much easier for the market to sell off. The fact that they're not makes it very, very difficult for it to sell off. Nonetheless, it still needs to sell off. Maybe this government shutdown will be the catalyst for that. We'll see, but I really very much hope so, because it needs to have a sell-off.